All right. Well, welcome everyone to the Psilocybin Assisted Therapy Association's in partnership with Calyx CPAs presentation and training on self-employment in the psychedelic industry. This is designed for us professionals on how to be self-employed and how to navigate the accounting and legal and insurance structures that are out there. This is a multi-part series. So this is number two. Our first one was a higher overview of self-employment, what that means, and then today we'll be diving more into the accounting and legal accounting structures and taxes. And really thrilled to again have Justin Batelier here with us, a huge partner and advocate for our industry, and partner and sponsor here with Psilocybin Assisted Therapy Association. So thank you, Justin. And as we're moving through, the event is being recorded and will be shared online a few days after. Part one is available online on our YouTube channel if anyone cares to go back and watch that. And this will be posted in a couple days. So housekeeping, let's keep the side chats to a minimum. Feel free to share if it's pertinent. If it's not relevant to the topics that we're talking, just have individual discussions or share emails and then continue on. So this way we can stay focused on what Justin is presenting. Also, there's no discussions around substances, procurement of substances. This is around business. So this way we can, keep everything up on YouTube and not, violate anything or put any of us in difficult situations. If you care to have conversations, do it on the side after that. This is everybody's open to sharing their opinions as long as we're doing it in a safe and respectable manner. There is no right way to do any of this, but there are ways that, could hurt other individuals. So be mindful of that and sharing information that we are aware and being present for everybody that's here. This is opinions by a professional. This is not a one and done. This is the only way. It's also going to be Justin's presenting on the accounting world on the CPA aspect. This does not mean that how it could affect other legal, matters or, depending on where you are at. Part three that'll be coming up next will be on our legal matters by Sean Clancy with Emerge Law Group. We'll be talking about, self-employment from the legal aspects and what he views. So another great one. And then we'll be diving into insurance after that. From Todd with Oath Insurance, who's one of the primary insurance providers, and then we'll be diving into in another session into some strategic planning. If anybody has any additional trainings that seem interesting to you that you think could be a benefit, please share that with me, and we'll see if we could add that in. So without further ado, I'll pass it over to Justin, and really appreciate you being here, and thank you so much for your dedication.
Yeah, thank you. Thank you very much. Yeah, I usually freestyle these kinds of presentations, but I do have a slide deck that I'm going to go ahead and share my screen. So just I just ask that you be patient with me if I end up deviating from it. Again, this is information that I know a lot about, and I talk to people on the daily about it. And I do a lot of education around these topics. And so this is, I guess, session two in regard to self-employment. And for those of you who might have been in the session one, I talked a lot about, whether or not you're considered self-employed person. I talked about specifically about some of the nuances of the psychedelic industry and how that differs from a regular business for you. I talked about the Controlled Substances Act and whether or not you guys are subject to the Controlled Substances Act and 280E and all that. And this is kind of getting into the nit and gritty of just some of the details of things that you should be considering as a self-employed person. And this is not anything different than anybody else would have to take into consideration, because these are the things that are like universal attributes to being self-employed. And so the main things that I'm going to be talking about are whether or not you are considered self-employed or are you an employee. I'm going to talk about some of the considerations around that, like the difference between being self-employed and being an employee, and the things that you have to be concerned about in regard to the taxes that you're subject to, and what you can anticipate there versus being an employee. I'm going to talk about various business structures and some of the pros and cons of each, and what I would recommend would be good for somebody who's starting out, all the way up to somebody who is highly profitable and perhaps employees and maybe even partners and whatnot. So like what kind of business structure would be good for me, for you, in the industry that you're in. And so this isn't going to be talking about service centers or medicine touching. Medicine touching is a little bit different. It has to be addressed differently than for people who are facilitating and providing service related types of things, coaches and spiritual guides and facilitators for us in Oregon. So let's see here. Oops. Bear with me. There we go. So my name is Justin Bautier. I'm CEO of Psychedelic CPA. I've been in business for almost 20 years, and the last 10 of those years have been really neck deep in the cannabis industry. And then the last few years, I've definitely been doing a lot more in the psilocybin industry in Oregon. And now I've been working with some people to the run up of the regulated industry in Colorado. And then I'm also working with some people who would be considered in the gray market in the psychedelic industry at large. And but I think that the information, so I can definitely provide some valuable information for people who are plant touching, people who are not plant touching. When I say plant touching, I mean medicine touching or trafficking. And so I can definitely help people there. And then for people who are not plant touching, like yourselves, it's kind of a basic conversation for a small business owner, and a lot of the things that apply for a regular small business owner doing other things applies to you. And that's what this presentation is more about, rather than kind of navigating the edge of being a trafficking business or not. And so I will continue. Okay, so the last session, I talked a little bit about the difference between being self-employed versus being an employee. And this is always very confusing to some people. And oftentimes I'm actually talking to the employer versus the people who are wondering if they're an employee or if they're self-employed, because it's really usually how the employer wants to address and hire people. And so sometimes people don't understand that they are actually a self-employed or business owner versus an employee. And even employers will say that they'll refer to their subcontractors or their independent contractors as employees, but that's not the case. If you're not an employee, then you're not an employee. So we have to be careful with the nomenclature, and that's kind of what this section addresses is, do you know if you're an employee or if you're self-employed? And so these are kind of the lists. There's a little bit of a list here that I have in terms of whether or not you're considered an employee or if you're an independent contractor. And so some of those are like, are you free to work for multiple clients? That's number one. Do you make your hours? And do you have control over your working conditions? Do you come skilled? Like, did you get your own training, and the employer and the person who you're working for, are they teaching you how to do your job, or do you know your job already? These are all signs that you could be considered self-employed. And when you start working for service centers or other companies that are then maybe collecting money for the services that you're providing, and then they pay you, if you are free to work for multiple service centers, or you are being paid by your clients, or you already come trained to do your job. And do you have an LLC? That's another thing. And I'll talk a little bit more about the LLC when I talk about the business structures. But if you come with, like, say, business entity in hand with an LLC and an EIN number, and you are trained already to do your job, and you work with the service center to choose your working hours, and you're not exclusively, you don't exclusively have to work for them, then you're pretty much a self-employed person. And sometimes the service centers, if they're collecting money from the clients and then they're paying you for your facilitation work, there's kind of a line on whether or not you would be considered an employee. And most of the time, the service centers, the employers would want you to be an independent contractor. And the reason why is because the tax implications are put on you, not on them. And that's kind of where, that's like kind of the big difference. And that's why some business owners are motivated to hire you as an independent contractor versus an employee. And then some people want more of that control. Like, no, I'm gonna tell my employees their out working hours. I'm going to be responsible. I'm going to be holding their insurance. I'm going to be responsible for the work that they do. Then that's kind of more of an employee employer relationship. Okay. So one of the big things is for an employer, and then also for you guys, when you're going into a relationship with a service center, is you're definitely going to want to have a contractor agreement. And this is really more for the protection of the employer. And again, I'm not calling them, they're not really an employer, they're the person paying you, but they're your customer, your client. So a service center would be kind of considered your client because they're paying you for services that you're doing for them, essentially. And so it's very important as the service center to have a contract with you, the independent contractor, so that you know that you are in business for yourself. And it helps a little bit to mitigate the liability as well, so that if, say, something goes wrong and something goes wrong in a session and then there's litigation, then having that contract is really helpful to make sure that you're not liable for what happened, or vice versa, the person who you're in contract is not liable for. So not that is all in, will do the trick completely, but it is definitely an important part of the relationship. And so then I'll talk again about forming an LLC. And I think I'm going to go into pretty soon here the business entity formation and like what are the different the different legal types and the different tax types. Oh, but first I wanted to talk to you a little bit about the differences between being self-employed versus being an employee, and what you have to keep in mind. First, probably the most important thing is what's called self-employment tax. That's the thing that really gets people in terms of whether they want to be an employee versus an independent contractor, is how taxes are being addressed. When you're an employee, then you get a paycheck, and from that paycheck, the employer withholds federal income tax, and we're in the state of Oregon, and it has an income tax, so it withholds income tax for the state of Oregon, and then it also withholds some money for Social Security and Medicare, and then the employer also pays state unemployment and federal unemployment. So the taxes are like, the tax impact is like somewhat significant. And it's the thing that makes people run away from payroll, at least as an employer, because the tax implications are pretty substantial. But so as an employee, that's being all taken care of for you. They're paying you, and based on some algorithms and some formulas, the payroll processor is withholding these taxes from your payroll. And it's really helpful because it's almost like it's not missed. It's done little by little. Every payroll, it gets done. And so you get to the end of the year and you file your taxes. And if the formula was properly applied to your payroll, then you don't have to pay any taxes at the end of the year. And sometimes you get a refund, which is nice. And with being self-employed, that doesn't happen. You get what's called a 1099. And a 1099 is just the gross pay that the service center paid you. And unfortunately, you're completely responsible for those taxes. And they can be substantial. And there are ways to mitigate the self-employment tax, but it's kind of a spectrum on whether or not, you know, a simple Schedule C sole proprietorship is the best tax entity for you, or would an S corp be better? And then in some cases, a partnership or C corporation. So again, I'm going to talk a little bit about those entities, those various entities, and the pros and cons around them. But if you do nothing, and all you have is maybe an LLC, which the LLC is a legal entity. I think that's the important thing to know about the LLC when I talk about it, is it's a legal entity. It's not a tax entity. So a legal entity is a limited liability company, and you can go on the Secretary of State's website and really easily apply for an LLC and register as an LLC. And then once you have that, that's kind of like your state registration. That's all you have to do. It's $100 here in Oregon. It's very easy to apply for. And then, you know, with that in hand, you pretty much have a business registration. So you are now like a legit business owner in that way. You are always, if you're being paid gross pay, or you're not, if you're being paid and it's not through the payroll system, then you are by default a self-employed person. You are a business owner, and you're required to file what's called a Schedule C. And that's your default entity. A sole proprietorship is your default entity. So you don't have to do anything, and you have to file a Schedule C on your tax return. Okay, and that's your default business tax entity. And so now, unfortunately, like, when the employer, because you're not an employee, you're responsible for all of those other taxes that I talked about, like Social Security and Medicare. You're responsible for federal income tax, you're responsible for state income tax, and you're responsible for Social Security and Medicare, what they call self-employment tax, which equals about 15.3% of your net income. Okay, so when I say net income, I mean you get paid by the service center. Then you've got some expenses, like you've got your telephone and you've got your computer expenses, and maybe you've got some home office expenses. You got some mileage expenses for commuting to and from the service center for doing your job. And you get to write all those off against that income that you were receiving. But then you're left with the net income, and the net income usually represents what you've been living off of this whole time. So I remember the very first time that I did my own Schedule C self-employed tax return years and years ago, when I was just doing bookkeeping, and I didn't make very much. I made $24,000 that year. And I remember my tax return, you know, on my taxes, I owed $6,000. And I was like kind of blown away by it, because I was barely above poverty level. And then I was put in poverty level because of the taxes. So that was really crazy for me. And so what it is, again, is you've got your net income. So maybe I made $2,000 a month that year. And that added up to be about $24,000 after my expenses. And so on that $24,000, I had to pay federal income tax, I had to pay state income tax, and I had to pay 15.3% self-employment tax, which is the Social Security and Medicare. And that was about 25% of my, you know, I had to pay 25% for what was, again, a low income. So it adds up very quick. And so as a self-employed person, you kind of need to be ready for that. You need to be ready. And I tell people that they should put at least maybe 25% of gross pay away. So the first expense of your business, and granted, this isn't a deductible expense, it's just money you want to set aside, 25% gross minimum. And if you're a higher income producing person, that 25% could be more potentially. Some people say even as high as 40%, which is, for maybe net income, 40% is good. gross, that's a little bit high, but it's something that kind of requires a little bit of tax planning. Okay, so some of the things that we can deduct though. So the idea now is like, okay, you're getting paid from the service center. Well, how do I reduce my net income tax? How do I reduce my tax on my net income, or how do I get my net income down? Well, you get to take some deductions, and some of the common ones, because you're a service provider for the most part, and so you're not going to have a lot of deductions because you're pretty much just selling your time. And it would be different if you were selling like a commodity or something like that, because then you can, or maybe you were manufacturing something, or maybe you had a lot of payroll and whatnot. But if you're a new facilitator right out of the gate and you're just getting paid for your time, essentially. And so that doesn't come with a lot of expenses for you, but you can definitely deduct some. One thing I recommend is a home office deduction. So you have a place in your home that's exclusively used for business, or at least if somebody look closely, it was exclusively used. So it needs to maybe be a separate computer. Maybe you have a desktop computer somewhere in your house, and then you have a laptop computer as well. That way you could say like, well, that desktop is exclusively used for business, and then this laptop is what we use for personal purposes. Then you can deduct a percentage of all your home expenses. So however much square footage that office takes up in your home, say you live in a very small location, you have a 1,000 square foot home, and 1/3 of that home is a room that's dedicated to your business. Then, and I know that's somewhat unlikely, but if you can argue that, then you can take 1/3 of all of your expenses. If you're renting, you can take 1/3 of your rent. You can take 1/3 of your utilities. You can take some other expenses, 1/3 of your insurance and whatnot. And then you can take your cell phone. Now, a lot of times they're going to want the IRS, especially Oregon. Oregon's a little bit more persnickety about these things than the IRS are. But the Oregon at least wants to see, hey, do you have a separate cell phone line, like two lines, one for business, one for personal? With the IRS, you could probably get away just sharing one and just be like, listen, I spend 50% of the time that I'm spent on the phone is for work. Easy, it's 50%. They usually are pretty good about that. Oregon, I've had mixed results, but so that's the home office. And then there's also just a standard home office, like per square foot, where you don't have to go through the rigmarole of allocating your percentages. You just tell the system or your tax preparer how many square feet your room is, and there's a standard home office deduction that you can take. But oftentimes, if you're renting, the square footage in proportion to your your office square footage in proportion of your total home you can deduct more, especially if you're renting. And then the home office is a requirement to have if you also want to deduct your miles to and from the service center that you're working. So if you're a self-employed person, you can deduct your miles, and I think it's like 56.5 or something like that cents per mile. So right now, if you're driving, 10 miles to work and then 10 miles back, you get about a $10 a round trip deduction every day that you go to that service center. Now, note that commuting is not deductible. So commuting miles is not deductible, but and in order to make sure that you can deduct those to and from, if you're going to the same place of business every day, in order to deduct those miles, you need to have your home office. You need to have a home office base, because you're like, my business is done in my home. I'm paying my bills. I'm using my computer. I'm updating my website. I'm working on my LinkedIn profile. I'm doing a lot of when I'm not doing the services at the service center, I'm working at my home computer and in my home office. And then what that does is it allows you a place of business. And then when you drive to the service center, that's you going to your client, essentially. And then that mileage is deductible. Or if you drive to a conference, or if you drive around, or maybe you go see somebody's house directly. Maybe I don't know if you can do the integration and the orientation outside of the service center. I think people can do it via Zoom, so I don't see why people can't go to people's places of business, but that's for you guys to know and not me. But if you're driving to places like, say you go to Home Depot or whatever, then you can deduct those miles. And if you go to, I'm trying to think of other things, like go to the post office and to the bank, you can deduct those miles. And the hard part is you have to keep a log. And there are like phone apps that you can do, like Mileage Bug or something like that, where it kind of stays on, and every time you get in the car, you like turn it on and off. And that's a good way to track your miles. So if you're going to take the miles deduction, you definitely want to keep track of the miles that you're driving. And that's always something that especially Oregon will bring up in case of like an audit, or they dispute the tax return that you filed, they dispute your deduction. And the IRS also is on the same page with them. Now, the IRS, again, is a little bit more lenient. Like, for example, if you're a real estate agent and those people drive all over the place. And if they don't have a log, they're like, well, we know you're driving, so we're going to give you a little bit. Can you come up with a reasonable amount? The IRS is great that way. Oregon is not. They're like, let me see your logbook. No logbook, no deductions. Okay, so that's what you have to think about. Whew, that was a lot. Okay, so let's move on. All right. So okay, so again, like being in business for yourself, you're going to owe taxes. You're going to want to, the taxes are being pulled from your payroll, right? So you're going to want to do what's called estimated taxes. So you're going to want to try to figure out, well, how much am I going to owe for the year? And that's very difficult unless you do some planning with an accountant or something like that. But maybe say you go ahead and pay that 25% in that I was telling you about. But that's when you're to the point where you're actually making money and you're pulling it out and you're like being able to live off of it. That's when you kind of know that you're netting positive here. And so you're going to want to make some estimated tax payments and pay throughout the year. That's what the IRS expects. The IRS doesn't really wait to collect those taxes until when you file your tax return. They want those taxes when you are making the money. Okay, so that's kind of an important thing to think about. You don't have to stress out about it right now. Okay, don't stress out about it too much. If you're brand new, don't stress out about it too much. But it's when you're like maybe in your second year of business, or even maybe the first year you didn't make a lot of money, but the second year you had a full year of quote unquote employment, then you need to start thinking about like paying ahead. You have to pay ahead. Okay, that's something that I tell people. But a lot of people forget. And then there's penalties if you don't pay ahead and you owe a substantial amount at the end of the year. You just, as a Schedule C, as a sole proprietor, which is your default entity, you just file it with your personal tax return on what's called a 1040, which is your personal tax return, and it's called a Schedule C. Okay, this is my favorite part of this presentation, because this is where you get to make a decision, and then you get the opportunity to save taxes on, to mitigate your tax liability. And earlier I talked about how I paid $6,000 on my very first $24,000 that I made. And I was like, wow, it's insane. But it's very real, and it's still real for you. There are options. And so I'm going to go through these business structures, and it may hit on some other people who may be in collaboration. Maybe there's like a partnership, or maybe you are a little bit more, you're like a bigger, more sophisticated company that has investment, or you're already established and you've been making money and you're making a decent living, and therefore you're paying a decent amount of taxes. Then maybe we choose a different tax entity for you. So again, the LLC is not a tax entity. The LLC is a legal entity. Okay, so the IRS doesn't see the LLC. The LLC doesn't mean anything to them. Okay, it's just That's just a legal entity. And that legal entity, that LLC, can be taxed as a sole proprietorship, a partnership, an S corporation, or a C corporation. Okay, so if you do nothing, if you're an independent contractor for, say, a service center, and you have an LLC, or if you don't have an LLC, you're automatically considered a sole proprietorship. But I highly recommend registering with the Secretary of State and getting your LLC. It's just a little layer of protection for you. And it legitimizes your business. And that's what we kind of want. We want you to be a legitimate business person. And so if you don't do anything and you just have the LLC, you're a sole proprietorship. And then unfortunately, you are subject to those self-employment taxes. But it's very simple and very flexible. Like the IRS doesn't actually see you any different than if you had an LLC or if you didn't have an LLC. If you were to get audited, they would audit your 1040, your personal tax return, and then they would want to look at all of your bank statements, whether it's even if it's under an LLC name. If you are a sole proprietorship, they will have right to look at your personal tax or personal bank account bank statements, and they can take a look at your business bank statements. There's no separation between you and your business, and that's what a sole proprietorship is. Now, as soon as you have more than one person, say there's two of you, and you're co-branding and you're working together and you're a partnership. Okay, so your partnership, if there's more than one, two, or more people involved in this business and you are working together, there are like little games you can play to where like only one person has to file a tax return and the rest, or you guys can each file your own tax returns and split up the profits and stuff, like profit share deals and those kinds of things to kind of keep things a little bit more separate. But if you're going in together on maybe purchasing assets, renting an office, and you guys might be a legit partnership. So if there's two or more people who own the business, then your default is a partnership. And what's great about partnerships is they're super flexible. Like you might have one business bank account and one person's like doing a lot more work than the other person, so that person gets paid more, and you can be flexible with how people are being paid. It's pretty much just like a sole proprietorship, but you've got more than one person owning your business. The downside of the partnership is that the taxes are treated the very same way as a sole proprietorship. So you get a K1. There's a tax return called a 1065 that we do. And then we give each of you what's called a K1. And then that K1 gets reported on your personal tax return. And then you are subject to federal income tax, state income tax, and self-employment tax. Again, that pesky self-employment tax. And so that's no fun. If you guys are equal, like, so first of all, you can be a single member LLC, or you could be a multi-member LLC, aka partnership. Okay. And then you can elect to be taxed as what's called an S corporation. So the LLC could elect to be taxed as an S corporation. And when you're like, I would say when you're like netting above 36,000 plus, when each of you, if it's a partnership, or you're able to like kind of start making a living and you're actually bringing money home and spending it on your personal needs versus reinvesting it in the business or losing money, then you may want to consider electing to be taxed as an S corp. The LLC doesn't change. Your tax identification numbers don't change. It's just a single form that your tax accountant can file, and then you can be considered an S corporation. And then what that does is it eliminates on your personal tax return the self-employment tax. So you aren't subject any longer to self-employment tax on your personal tax return. So for me, when I filed my very first S corporation, I learned this. It was relatively new. Like when I first did this 15 to 20 years, 15 years ago, say, the attorneys actually didn't know a lot about it. about it. They thought, oh, only corporations could be taxed as an S corp, but the IRS got a little bit more clear about their guidance on having an LLC being taxed as an S corp. And so now it's common knowledge, and any accountant that knows business should know this, and that is that your LLC can be taxed as an S corporation, and nothing else needs to change, except for now you have to file what's called an 1120S, and then you get a K1, and then on your personal tax return, just like a partnership, you get a K1 on that money that you're being taxed on. It's no longer subject to self-employment tax. So for me, I have a tax return where I net $24,000 and it comes through as a K1. Whereas before I was paying $6,000, well, now I'm paying $3,000. That's what it did for me. It reduced my tax rate from 25% to 10%. And now I'm in a much better position tax-wise than I was before. It's more complicated than that, but that's kind of the gist of the S corp. The thing about the S corp is you're now separating yourself from your business. Okay, so now the IRS is like, when they audit your business, they're not auditing you personally. They're auditing the business, and they only have access to your business bank accounts and stuff like that. So then it limits their accessibility to you. So that's one thing that goes on. But with that, you end up also wearing two hats. You're wearing I'm a business owner hat, and I am an employee hat. So now you're making things a little bit more complicated for yourself, but usually the upside is much better for you. If you have a hard time, handling complexity, then you may want to be slow on the uptake of the S corp. You know what I mean? Like the transition, because it can be very confusing to some people. But if you can't afford to hire a decent accountant, that accountant can guide you through these things. And there probably is a little bit of trust that you have to have with them, because they're going to know a lot more than you, and it's going to be very hard for them to teach you all that is going on here, because there's a lot of little nuances that are happening. But what I can say is that depending on your income and depending on the taxes that you're saving, even with the additional accounting costs to help have somebody administer that S corporation, it usually is in your favor to do that. So the hard part with it is you do have to, at some point, especially if you're pulling money out of your business, you have to put yourself on the payroll. And so, I mean, and you don't have to rush into it. You can be in business for yourself a little bit as the owner and get paid through distributions and whatnot, which are not taxable. But at some point, you're going to need to get yourself on the payroll and pay yourself what's called a reasonable wage. And so S corporations are required to pay a reasonable wage. The hard part with that is that what is reasonable, right? That's open to interpretation, and that's where you have a little bit of leverage there, because some people who are facilitators don't get paid a whole lot and are not necessarily super busy in it and super successful. It's very hard for the IRS to come back and be like, hey, you didn't pay yourself a reasonable wage. But that's where you're going to get a lot of differing opinion from the accounting industry. Some accountants are going to be very conservative and say like, oh, reasonable wage is everything that you're pulling out of everything that you're making. That's a reasonable wage. Everything you're making is a reasonable wage. But that's not necessarily true. I would say right now, you could even pay yourself as low as $3,000 a month through the payroll system. I would just recommend using Gusto. I would definitely recommend being guided through this process. But say you're making $60,000 a year, or 60,000 net income a year, and you pay yourself $3,000 through the payroll system. Through the payroll system, you're paying those Social Security tax and the Medicare and whatnot. But then on your distributions, you don't pay the self-employment tax. You don't pay the Social Security and Medicare tax. So you're essentially saving 15.3% on anything above the $36,000 that you pay yourself through the payroll system. And then that you can make more and more money as your income grows. You can make more and more money, and the tax savings of the S corp continues to grow with that. And so that's what's really cool about that. So and then you just have to make sure that you've got some substantiation, like I make $20 an hour or something like that, and that's what I pay myself through the payroll system. And there's always a chance that there could be a dispute, but I have done, at least personally, thousands of business tax returns as corporations and whatnot, thousands of them. And I have never had anybody dispute, the IRS has never disputed the reasonable wage. And so therefore, there is like motivation for you to pay a low wage and then take distributions out. And then there's games that you can play with that. Like, for example, my business is an S corp and I pay myself a wage. It's relatively low for the CEO of an accounting firm. And what I do is through the payroll system, I pay all my wages out in taxes. So I'm just like, hey, just take all my wages. But then I live off of the distributions. So I get distributions every month and I live off of those distributions. The IRS probably wouldn't like that necessarily, but it's nothing that has been argued. And I don't even hear in the grapevine the IRS coming down on people. Now, if you are like a doctor, okay, or a dentist, or you are an attorney, your wage needs to be higher. So my wage is a little bit higher than that 36,000 I was recommending, but that's because like I have a little bit more. But it's certainly not so high that I'm not getting a lot of benefit from the S corporation. Okay, so I know it's a big conversation and pretty complicated. And I didn't mean to spend so much time on the S corporation, but when you start making money and you start feeling those self-employment taxes, you're going to want to make a transition. You're going to want to be like, oh, that hurts. Like, I got to do something different here. And the S corporation is your solution. Now, some people will say because you're in a psychedelic business, and then the IRS could say, oh, you're plant touching, or they could say you're subject to 280E. So some people argue that you should be what's called a C corporation. The C corporation is a standalone business altogether. It's not what's called a pass-through entity. A partnership and an S corp are called pass-through entities. You get when we do an S corp or a partnership, you get a K1, and that K1 gets reported on your personal tax return, and then that's what you pay taxes on. With a C corporation, that doesn't happen. With the C corporation, the income stays in the C corporation, and the corporation pays the taxes, and you get paid out as a W-2 employee in its entirety. Jason, I realize it's 12:45. I have more to talk about. I just want to make sure that I'm okay to continue.
Yes, that's fine to continue. I do have a couple questions. Would you like me to ask them now?
I think so. I think after I get done kind of talking about the business structures, I'm almost done with the presentation. So we can stop now and I can answer some questions, and then I'll just give people a little bit of advice about if they're new to self-employment, what are the steps that they should take to getting prepared to be self-employed person. That's my last thing that I'm going to be talking about.
Excellent. Yeah, we'll just do these questions real quick, and then we can fine tune it. And thank you all for being here and being present for all of this.
Yeah, it's a lot. It's a lot.
This is great information. I'm learning a lot myself. So the first one, what is the difference in filing taxes with an EIN versus one's own Social Security number?
Don't do one's own Social Security number. Always get an EIN number. You're going to get 1099s from the people who are paying you, and you don't want them floating documents around under your Social Security number. So it's easy. So that's going to be in the next slide. I'm going to talk about some of the steps to getting started, and applying for an EIN number is one of them, is one of those steps. Yeah, I'll wait to expound on that.
And then the next one was around for starting a nonprofit around, a corporate structure. And I can chime in on this as well. And one of the additional trainings that we're looking at doing, I think around like part 5, will include information on nonprofits. That's my background. Specialty is in nonprofit corporations. So yeah, Justin, if you want to chime in, and then.
I mean, it's nonprofits can be complicated, and unless there's a really good like reason to start a nonprofit, like Jason, in your case, it's a good an association or a nonprofit organization is a good move. I wouldn't complicate it. One of the things that a nonprofit has to do is file a 990 a tax return, and their short version is called the 990EZ, and it is one of the most complicated tax returns that you can file. So you're going to get hit up with some accounting costs for that 990 and 990EZ. Initially, you can probably get away with. I mean, it certainly is a way to defer. You could potentially defer taxes by keeping the money in the nonprofit, but you got to have a nonprofit motivation. And then it's just a little bit more rigid in terms of how you have to handle the taxes and stuff. And if you're paying out the profits of the nonprofit, if you're paying out that, then you're going to get it as a W-2, kind of like a C corporation would. You would pay out the profits of the organization out as W-2, as a W-2 employee, and then you're going to pay taxes on that. So you're not going to get around paying taxes as a nonprofit. And you're not plant touching. So if you're not plant touching, you've got a little bit more protection for maintaining the 501c3 versus like a service center or plant touching business trying to operate a nonprofit, because the IRS will not recognize a nonprofit for a plant touching business. They will recognize a church. That's different. That's a different animal. That's for a different professional.
Yeah. Churches are very complicated and can be a whole another topic. For starting a nonprofit, really any of the corporations will work, because once you apply and you get your tax exempt status, then the tax rules change around what the corporation owns. But like what Justin was saying, your individual taxes, you're still charged on what your income is. But if you want to start a nonprofit, as long as you have an EIN and a corporation that then they can put the tax exempt status, the 501c3 on top of it, it really doesn't matter, because then the new rules kind of supersede what's on there, and then it changes the state. But you couldn't do it under a sole proprietorship or just an individual. You would need to have an actual corporation and an articles of incorporation to do that. And then corporate taxes really in the filing can depend on how large of an organization you are. If you're under 50K a year for the first 3 years, they allow you to just kind of do an easy route, but then it does get more complicated. And we can get into more of that. And if you have more questions, feel free to reach out to me. I'm happy. I do consultations around this in the psychedelic industry for free. And we will be talking about this in a future episode. So thank you. And that was the quick questions, I believe.
Okay. All right, so let's see. Oh, choosing the right business structure. I think I already talked to you about that. Okay, so say you're new, you just got out of facilitator training and you're picking up your very first customer who's a service center, or maybe you get paid directly and you're bringing your customers to your clients to the service center, and then the clients are paying you directly. That's one of the models that I see out in the industry, is that there's pretty much like two. One is the service center has their clients pay you directly, or maybe you bring your clients to the service center and they might charge you a room fee, or maybe your client who you're providing facilitation services pays the service center directly. But one of those is that the client, the person who is taking or is undergoing the session, pays you directly for the services that you're providing, and then they pay the service center the room fee and the medicine. Okay, so that's how that sometimes is structured. The other way is that the service center collects the payment from the client who's doing the session, and then it pays you. Either way, what the first thing you want to do is you want to register an LLC. That can be done on the Oregon Secretary of State website. You can do it by paper form or you can do it online. And it's very simple. Don't get bogged down with all the questions because the answers are almost all the same. And that is your name, the name that you want. Try to avoid anything with psilocybin in the name or psychedelics in the name, because you may want to get a bank account. And if you put psilocybin or psychedelics in the name, they're not going to give you a bank account. Like an ordinary bank won't give you a bank account. Now, Jason knows some people with First Citizens Bank, and they'll give you a bank account knowing that you're in psilocybin. But traditional banks won't. You're not plant touching, right? And the money that you're receiving is not related. It's very loosely related to the sale of the medicine, but it is not related to the sale of the medicine. So you should be able to get a legit bank account. That should not be denied you, but you may have to not be honest with them as far as what you're doing. What you're doing is you're doing therapy or you're doing caregiving services, like you're a caregiver, you know? Okay. So when you go on the Oregon Secretary of website, if you are doing Oregon, if you're registering in Oregon, be careful. They will ask you if you are going to have employees. When you first start out, no employees. Just tell them no employees. And they may even follow up and ask you if you want what's called a business identification number, a BIN number. Now, when you register your LLC, you're going to get an Oregon registry number. Now, don't be confused with that Oregon registry number. You're going to put that on the shelf. Like, you're not going to need it for almost anything. You're going to get your LLC. They're going to give you a registry number. You put that registry number away. You're not going to need it for anything. And don't get it confused with your EIN number that is provided by the IRS, or your BIN number, which is provided by Oregon. So Oregon might ask you when you're registering your LLC online, do you want a BIN number? Just say no, you don't want it right now. You don't want that. That is only when you have employees. When you have employees, then you want to get an Oregon BIN number. And this is a little funny, because what I am going to ask you to do is go get an employer identification number with the IRS, which is so funny because that's more like the tax identification number that you need as a business owner, whereas the Oregon BIN number is more like an employer number. So be careful, don't get tricked. The BIN number is for when you have employees, and the EIN number is for anybody who owns a business. You want to get and you just go to irs.gov and you apply for your EIN number. Be very careful when you type it in Google that you're going to the IRS's website, because there's going to be a lot of ads and there's going to be a lot of people who are going to trick you into applying for the EIN number through their website, and then they're going to charge you for it, or worse. So you need to be very careful what website you're applying for the EIN number. But applying for an EIN number is super simple. It's not too difficult. You're going to say you're an LLC. You're a sole proprietor for now. You do coaching, consulting, caregiving, whatever you want to call it. They're going to ask, what do you do? And you're just going to be like, I provide a service, and it's consulting or it's caregiving or something like that. It doesn't really matter. You can put psychedelic services in there too, and they're not going to bat an eye. EIN numbers are given out all the time, millions of them. Then you're going to want to take that LLC and the EIN number, and then you're going to want to go apply for a bank account. You want to get a bank account. because you want to make sure that all your income is being pointed towards that LLC and EIN number and put into your business bank account. And then all your expenses are being paid out of that same account. And then when it's time for you to get paid, you pay yourself that money. Okay. You write a check to yourself. You don't spend your personal, you don't put your personal expenses through your business bank account. You keep your business bank account completely separate from you personally. You don't pay for your home office expenses through your business bank account unless it is very much for business. So like you're buying a computer and you know that computer is only going to be used for business, you buy that computer through your business bank account. You don't pay your gas and your auto expenses through your business bank account. What you're going to do there is you're going to keep track of your miles. You're going to do miles, not actual expenses, miles, because miles are better for you. They will be better. I can almost guarantee it for what it is that you guys are doing. You're going to pay your licensing fees. You're going to pay maybe even your training, your continuing education through it. You're going to pay any kind of legal professional fees through it, your tax preparer. You're going to pay for meals. You're going to pay for hotel rooms. If you go to a conference, you're going to pay for the conference fees with your business bank account. Anything and everything that you can kind of legitimize paying with your business account, that's what you want to do. But if it's for personal purposes, don't pay your personal expenses out of your business bank account. What you do is you write a check from your business account to your personal account, and then you put that money in there, and then you spend that money out of the business bank account that way. That's the right way to do it. Okay, and then the final thing is, at first it's not going to be complicated. You can do your bookkeeping after the fact. Like after the year is over, you can do your bookkeeping. But if you're invoicing people and you're trying to keep track of like who's paid me, who hasn't paid me, then you're gonna and you can also keep your your income and your expenses clear, and you can see like, oh, like I made this much. It's like it's July now, and you've been working all year. You can look at the what's called an income statement or a P&L in QuickBooks. Say if you're using QuickBooks, and you can look at your net bottom line, and you can be like, oh, that's my taxable income right there. And then that is what you can put into some software to see, well, how much am I going to pay in taxes if I'm a sole proprietorship and I made this much, and say like I continue making the same amount, then you can kind of guesstimate what you're going to owe, and then you got to consider, okay, I better get ready for taxes. And then that's also really good for if you're meeting with an accountant to decide, is an S corporation good for me? That's how we know. Like the first thing that we would say to you is, pardon me, I've been talking too much. Let's look at your bookkeeping. That's the first thing that I do. I say, let's look at your bookkeeping and let's see where you're going to land in terms of your net income from the business. And let's try to forecast what's going to be at the end of the year. Is an S corporation good for you? And then you can weigh the pros and cons of each, the additional accounting costs versus the taxes that you're going to save. Is it worth it? Is it worth it to add that layer? So then that's kind of that's the important thing about bookkeeping. And then if God forbid you do get audited, you just print out a report and you send it off to them, and they love it. The auditors love it. If you've got good bookkeeping, it makes your chance of not undergoing a bunch of tax changes much better if you have a nice set of books. Or if you want to apply for a loan. If you want to apply for a loan, an income statement and balance sheet is what banks will ask for. And if you've got those, great. I mean, QuickBooks Online makes it so easy now. It's just that it's a little expensive, which I hate. But there's also simpler double entry accounting softwares out there. But I recommend QuickBooks Online. All right, I think that's it. It's 1 o'clock.
Excellent. Yeah, do we have any other questions?
Let's see here.
There's a question that just popped in there, Justin, if you want to take a look at that.
Yeah.
And if folks have to go, we'll say thank you very much for attending today's, presentation. And, Justin and I are both available for questions, independently. Justin's super great to work with. And if you do need to get going, please feel free to, and look forward to seeing you at the next one. If you have some more time, please hang on and we'll answer questions.
Yeah. So the question that I haven't read all of them, but the one about whether or not you're an employee and a self-employed person, the answer is yes. You'll get a W-2 from your employer, and then for your self-employed work, you're going to want to get an LLC, an EIN number, and a bank account. You're going to want to have your employer direct a payment for the facilitation work that you're doing to your business, which you then put into your business account. And you will be required to file what's called the Schedule C, and you're going to want to prepare for that. If you have multiple businesses with similar adjacent roles, do you recommend separate LLCs, EINs, or is there another way to manage that? I would just keep it simple, just keep it all under one. You may have people directing payments under different businesses. You just make sure that everybody's updated. If you get merchant services, for example, they require what's called a W-9. There's this form called the W-9. You fill that out, and that's how you tell people how to pay you, and where to direct what's called the 1099. So if you're an employer and you're paying somebody for personal services over $600, then you issue what's called a 1099 at the end of the year. Assuming you're not paying those people that, maybe you are, you would be required to issue what's called a 1099, but usually it's going to be the service centers or your employers. Remember, they're not employers exactly, but your customers, the service centers, will issue a 1099 to you. You need to give them a W-9. The W-9 is what gives them the information to direct the payments and issue the 1099s. I think you should just keep it under one. Like I like to keep it simple.
Yeah, that's great. Well, I really appreciate your time, Justin. Thank you so much. And
Thanks for having me. Thanks for listening.
yeah, just appreciate your efforts and dedication to the industry. And I don't know, Justin, maybe if real quick, if you want to enter in your email address into the chat, if folks want to reach out to you
I'll give people my website address, I think.
Yeah.
I'll put in a link to go to my website.
And then I'll be stopping the recording here in a second. And if people want to ask additional questions after the recording's off, either if your information won't be shared, you feel free to do so at that time. But otherwise, thank you everyone very much for attending, and look forward to seeing you at part 3, where we'll be diving into the legal structures with lawyer Sean Clancy of Emerge Law Group, another huge advocate in the industry. Thank you.